Last week's decision from the US Supreme Court that President Trump's tariffs in some areas are unlawful is a good sign. It shows that the institutions, at least for now, are still holding. If that really stays over time, we have to see. In his initial reaction, President Trump came up with new tariffs on another legal basis. And it has to be seen what this means for global trade and for the US economy. What it actually means is that uncertainty about tariffs will stay. And although a win of the Democrats at this year's midterm elections might reduce the power of President Trump a bit more, we don't think that there will be a big change in the way he is doing business at the end of his term. Now, for the economy, it does not really change much what's going on now. It might have potential bigger impacts, but for the time being, we take into account that in the US, the second half of last year was actually stronger than we earlier thought. Therefore, we revise up our growth forecast for US growth in 2026 to 2.2%. On the inflation side, the situation remains unclear as additional tariffs might again lead to some upside pressure on inflation. We don't think that under the chairmanship of Jane Powell, the Fed will cut rates again, but then under a new chair, what most likely Kevin Warsh will be, we still think that there will be rate cuts to come in the second half of this year. We still expect 3 cuts to be done under the new chair. In Europe, we had also a couple of data, and we do not think that this changes the outlook for the economy massively. We have to take into account that we had a relatively harsh winter, which would undermine economic growth in the first quarter. So we stay with our forecast for the time being on the growth side, but we have revised down our forecast on the inflation side something because the January data were lower than expected. And January is quite important because we have seen quite a few changes on the statistical side, and that suggests that during the course of the year, inflation will not be as high as we thought earlier. This has consequences on the outlook for the ECB as well. We took away our forecast of a rate hike at the end of this year and now expect rates to be unchanged for 2026. In February, we on a regular basis do our 5-year forecast as well. On that side, we think that we have 2 overlying themes. One is geopolitics for the developments on the global level, and the other one is artificial intelligence. On the geopolitical side, of course, inner political developments in the US play a major role. And we think that the US wants to demonstrate that it's still the leading power in the world. And that might lead to some more military action over time. China, the uprunner, might come up with some action as well. And there might be some kind of sea blockade coming up, but we don't think that it will escalate in an occupation of Taiwan or something else. But it will remain kind of uncertain what's going on the geopolitical level, and Europe has to find its way, how to navigate through all of this. It probably will strengthen its sovereignty and it's likely to expand its military expenditures, and this is likely to be partly done on a common basis. But Europe is not only facing the pressure from outside, there are also internal fractures coming up. And this might be reduced a bit in the very near term when Viktor Orban might not win the election in Hungary, and therefore one guy making trouble in Brussels will not show up again. But there are important elections coming up next year in France and also in Poland. And this might make much more difficult to come up with common solutions. And of course, in Germany, we have some state elections as well. And there, a win of the right-wing AfD might reduce the wiggle room for the German government to go ahead with European solutions. At the end, we think that there will be an agreement to do more on a European level, but it remains a struggle. Regarding the medium-term outlook on the global level, and particularly for the US, we think that investment in artificial intelligence is playing a big role. This year, we have so many commitments that the investment in that sector is likely to be strong. But all of those investments will come under scrutiny of markets in the view which return they will bring. And I think this will get even more challenging next year. So we expect a correction in AI investment in 2027, which will have a negative impact on equity markets, where from the peak to the low, we think that we have a more than 10% fall. And with this, the outlook for the overall economy might be deteriorating. So we see a kind of a slow patch in economic terms in the second half of 27 and in 28. So this kind of hump is likely to have, not just for the US, but also for the global economy, some negative implications. So there will be a slowdown in growth. We do not forecast a financial crisis or a recession, but growth definitely will take a pause. At the end of the 5-year period, we think that there will be some recovery, but it will not be with the same pace as we had earlier in our forecasts. On the outlook for inflation, this probably will dampen a bit the inflationary pressure, and at least for the ECB, it will give room that they can leave rates at a lower level. This is also likely to have some impact on the long end, where we reduced our forecast for 10-year German bonds, and now at the end of the forecast period between 28 and 2030, we think that 10-year bond yields will be around 3.1%.